Okay, now let's cover exchange options. A little warning here. We're going to cover these options called exchange options. If you go to look them up on the web or in a textbook, you might get confused because you'll see what's called exchange traded options. Well, most of the options that we've been dealing with, meaning the standard plain vanilla options, those are traded on exchanges. But so if you did a search, you're likely to find plain old standard plain vanilla option discussions. This is an exchange option. It's different. This option involves two risky assets where you basically swap one asset for another. In other words, you got stock A and you have stock B, and what an exchange option does is that the payoff here is a function of the maximum of 0 or stock A at expiration minus B. B here. Okay, it's kind of like a spread option, and the spread is the difference between the two stock prices at expiration is the payoff. These are very tricky options, as we'll talk about here in the video, but when you do the search, you might want to look up Margrabe as another descriptor for these options, because this is the individual who developed this model and the methodology to value exchange options. It came from the Journal of Finance in 1978, quite an old article. So these have been around for quite a long time, but they are quite tricky. So exchange options, Margrabe, and sometimes they're called exchange one asset for another. Okay. Now let's look at this carefully, this payoff, because it's a little tricky here. We are going to, in this setup, this is basically a call option on stock A, where we basically have, look at it, we have the strike. So normally you have this when you look at an option. Basically the strike is the stock B. And it's basically a floating strike, kind of, we've seen floating strikes before in the exotic options part 1 video. And so here we have what's thought of as a spread, the difference between the two prices. It's a call option on stock A, and it's also a put option on B simultaneously, because you're giving up B, right? That's what the minus sign is saying. You're giving up B and you're getting A. So this option, if you look at it, we're going to look at it from the call perspective. So it's a call on stock A. Let's look at it from that view throughout this video. It'll keep our heads on straight. We will only want to exercise this option, or it's only going to be in the money, if the price of stock A is greater than the price of stock B. In that case, it's worthwhile to give up B and receive A. So that's the premise of these options. Now, let's look at some of the tricky components of this. The tricky part of this is, what if we were to, let's try to model this on a binomial lattice. Let's think about how to do that on a lattice. Well, let's think about, okay, we're going to start off with SA today minus SB today. And what we've done in the past is we've multiplied the starting value by U, and then we multiplied it by D here to go down and up and so forth. But what happens now? What happens if the two prices of A and B, the price of A and B, are equal? That means the spread at this point is 0 between the two prices. And you can't really multiply it by a U or a D to develop the lattice work for this. So we kind of strike out on that from that end of things. Now what if we, so let's instead, let's model just A on a lattice like we've done before. Let's model B on a lattice also, and combine the two, and we'll have a spread. Well, the problem is, how do you capture the interaction between the two lattices? You got two lattices, but how do they intertangle with each other? There's no, I don't know if there's, I don't think there's a solution to that using two separate lattices. So Margrabe came up with a really neat idea how to handle these, and here's what we do. So there's a couple of tricks here that we're going to do. The first is, let's look at the payoff. Okay, so here's the payoff. This is the payoff at expiration. And what we're going to do is we're going to divide. Let's divide, that's D, both sides. Oops, just divide this by SB. Divide by SB. Oops. SBT. And we get the maximum of 0. We get STA over STB minus 1. Now what we've just done was we anchored the strike as 1 because it's relative really to SB. So SB becomes, when we do this, becomes what's sometimes called a numeraire, or what I call like a base. It's valuing the option relative to stock B. Now when we do this, what we're going to do is we're going to model on the lattice, we're going to model this difference here. And we're going to model that difference, and when we get to the end of the lattice, we're going to multiply this whole payoff right here. This whole payoff will get multiplied by the stock price of B at time 0. And that'll translate it into dollars again. Okay, so when you're just looking at this component, this is not in dollars anymore because everything's measured relative to stock B. But now when you multiply it by stock B at time 0, you get it back into dollars, and then we're going to take these dollar amounts, which are on the terminal ends of the lattice, and discount it back. Now, one of the things we have to be concerned about with now is, okay, how do we model this? What is the volatility? You know, normally we have a U, and we need E to the sigma square root of T over N to come up with a U, and D equals 1 over U. Okay? So now what we need is we need to get the volatility of these two. Well, it turns out the volatility of these two is measured this way, and it comes right from portfolio theory. So the volatility of the combined relative, in other words, these two relative assets, is the volatility of A plus the volatility of B minus 2 times the volatility of A times the volatility of B times the correlation between A and B. The correlation. This should look somewhat familiar and similar to portfolio theory. Now in portfolio theory, if you recall, it was the variance of the portfolio equal the variance of A plus the variance of B plus 2 times the variance of A, variance of B, correlation between A and B. And this was called the covariance, by the way. It was a plus sign in portfolio theory because way back in portfolio theory, the context was you were long 2 stocks. We were long stock A and stock B. And so what is the volatility related to the portfolio of stock A and B? Well, since we were long, it's going to be this plus this interaction term. This is the interaction term that came from Markowitz in his 1952 article, which was the beginning of modern portfolio theory, which, hey, 1952, it still applies today. And so this is from portfolio theory, but here, with a spread, with this spread, so to speak, between the two prices, we're basically long stock A and we're short B. And so if we're long A and short B, the short sign means we're giving up B. That's where the negative sign comes in. And so you see this, what happens is, you know, if you have the right if you have a correlation that's positive, it's going to offset these because this is negative. Okay, so there's basically what I'm saying is there's interaction between the two that has to be accounted for in these exchange options, because it's really one price relative to another price, and you have to catch that relativeness in the model. Okay, now let's actually do an example and try to pin this down. You've got enough background to do an example. Okay, so here's the example. We're going to assume stock A is 100. Stock B is 100. Okay, so both stocks are starting out at the same price. We'll say that sigma A equals 0.2696. Okay, so that's the standard deviation of just A. The standard deviation of just B is 0.1348. We're going to assume a T equals 1 year, 2 steps, so N is 2. We're going to assume the correlation between the two is 0.5. So that's a pretty common correlation, meaning you know, it's in the range of what typical stocks are, at least in the U.S. 0.5 correlation would not be unusual. You know, the range often goes between 0.4, by the way, to 0.6 on average, you know, depending on the time period you're looking at and the index you're looking at. You know, that's reasonable. So remember, correlation, by the way, goes from -1, where they're perfectly negatively correlated like this, the returns of the two stocks completely offset, and it goes to all the way up to +1, where the two stocks move perfectly in sync with each other. Here you get no diversification. Here you get total diversification, because the returns of those two stocks basically go to 0. They offset each other. And the returns of a portfolio between these two is just as volatile as the individual stocks, because they're perfectly positively correlated. Now, if the stocks had a correlation of 0, it's really hard to draw, but there's, you know, you recall from statistics, something with a correlation of 0 is basically statistically independent and uncorrelated and unrelated to each other, is what's going on there. Okay, so now let's look at what else do we need here. We need an R, but I'm going to tell you right away that we don't need one. Don't need an R. I don't want to call it an X. I'm just crossing it. Maybe cross it out here. I don't want to create an X anywhere. So there is no risk-free rate, because as it turns out, there's no way that you can create and replicate this in a risk-free way. So there's no risk-free asset involved. We don't discount any of this back. Basically, the opportunity costs of A and B are in this model are offset. There is no bond, so to speak, in this model, and I'll talk a little bit about that when we implement the Black-Scholes model in this. But for now, keep in mind there's no risk-free rate associated with this. There's no discounting. Okay, so now let's actually do some computations and develop the lattice work. So first thing we want to do, let's get the variance of this combined asset here, this combined spread. So it's the variance of A plus the variance of B minus 2, variance A, variance B, correlation A and B. So this is 0.2696 squared. Let me just work this out. And when we do this, the whole calculation comes out to be 0.0545, and the square root of that equals 0.23346. That's the sigma of the combined this option, where we're looking at the spread or the combined action of the two securities. Okay, that's our sigma that we're going to use. So therefore, remember, we use sigma to calculate the up move and the down move. So this is e to the 0.23346 times the square root of t, which is 1 year, over n, which is 2 steps. And this translates into a u of 1.1795. And remember, d equals 1 over u, and that equals 0.8478. Okay, so we got our u's, we got our d, we got our sigma. Let's do the probability of an up move. And remember, from the standard plain vanilla option, it looked like this. The probability of the up move on the lattice work was 1 plus the interest rate. So there was always, under the standard plain vanilla option, there was always this upward bias in the price of the option based on, the interest rate, the risk-free rate. And then we minus D, and we looked at the difference in D. Okay, this is going to be 0, as I said a few minutes ago. That's going to be 0. So in this case, the up movement for this lattice, the relative up movement, is going to be this. That equals 0.4588, which means the probability of a down movement equals 0.5412. Okay, let's look at the lattice now, with keeping in mind all this information. So we start off the lattice. Nice and big here. We're going to start off modeling A time t, SB over SB time t. Okay, that's SA over SB. That equals 1. Because we started, both stocks were at 100, so it was 100 over 100. Now the up movement is 1.1795. The down movement is 0.84. No, what the heck? Yeah, 8478. Okay, and we multiply it out. Okay, so this comes out to be, let me see here. This comes out to be, oops. $1.795. This comes out to be 1.391. 1.0. Let's see. This comes out to be 0.8478, and this is 0.719. So there are the payoffs, right? Now, oh, I'm sorry. That's the relative values at the end. So it's kind of like this is the stock price in a sense, like when we did a plain vanilla option. Right? But now we need to figure out what are the payoffs. So remember, the payoff is the maximum of 0 SA over SB minus 1. And then we need to multiply it out by SB at times 0. Okay, and these guys here are expiration, so they're capital T's. So what we need to do is we need to subtract 1, and we get 0.391, multiply it by the value of the stock of B, the value of B at time 0. That's 100. So the payoff is $39.10 for this exchange option, okay, on the up move. Now, on the up and down, down and up, it's going to be 1 minus 1 equals 0. So if we multiply it by the stock price, you get 0. And here, so basically the option is at the money. And here it's out of the money because the stock price is lower than, of A is lower than B. So you'd never want to exercise it in that case. So this payoff will be 0. So now we got our payoff. It's only $39. It's the only payoff we have to deal with. Now let's multiply it by the probability of an up or a down, which the probability, it's just two ups here, is 0.84. No, it's not. It's 0.4588 squared, because it goes up twice, and therefore the value of this option comes out to be equal to $8.23, and that is the value of the option, given that the two stock prices right now are 100 each, and the correlation between these two stocks are 0.5, and we got a standard deviation for A around almost 27%, B around 13%. It's a one-year option, 2 steps. We calculate it for this exchange option, swapping A for B. In other words, giving up B to get A. It's $8.23. And as I said earlier, I mean, this is the call for A, but it's also, think of it as the put value for B, because they're simultaneously the same thing. Okay, so let's cover the Black-Scholes-Merton model for this exchange option. Now, before we do that, let's back up 1 second and look at the standard Black-Scholes model, and then we'll apply it to an exchange-traded option. An exchange option. Okay, well, we had, remember, C equaled the call, value of the call, equaled the stock price times ND of 1 minus the present value of the strike that's discounted at the risk-free rate over period T, and then we had ND of 2. So these were probability factors, and also represented in this case the number of shares needed to create a riskless hedge. You remember that story, right? So if you put a little t here, just to be clear, at time t, right, this holds. If you rearrange this, what you'll get is ST ND of 1 minus CT equals XE minus RCT ND of 2. What this tells you is, look, you know, this side right here is essentially a riskless bond, or what's sometimes called the replicating portfolio, in a sense, because what happens is this side right here has to be risk-free and grow at a risk-free rate, because that's exactly what this side does. This side doesn't, when things change, when you have an instantaneous change in the stock price, remember ND of 1 and ND of 2 remain constant, and what you get is a change in the stock price changes the call, but these things offset each other because this side never changes. So the same thing happens here. The stock price changes, the call price changes, the NDs remain constant. This side has to grow at the risk-free rate over time, just like this side does. And that's basically a risk-free replicating portfolio concept there. It looks a lot like, by the way, remember we did the binomial. We had 8 shares of stock. We shorted a call. That's the negative sign here, right? And that grew at the risk-free rate because we had set up a situation where we had just the right number of shares, H, which are now here, so that the portfolio was risk-free no matter if the stock went up or the stock went down. So you can see the similarities there. Now with the standard plain vanilla Black-Scholes, the D of 1, remember, was the log of the stock over X. That is basically when you take the logarithm of that fraction, this is the percent that it's in or out of the money. Then it was plus R plus sigma squared 2t over sigma square root of t, and then D of 2 equaled D of 1 minus sigma square root of t. Now, so that was what we saw before. Now let's compare this to what the exchange option is going to look like here. Now, the exchange option is going to look like this. It's going to be, I'll write it over here, the call equals stock A ND of 1 prime, okay, minus stock B ND of 2 prime, okay, where the D of 1 has to be adjusted for the fact that we're dealing with an exchange option. Now keep in mind that these are just the right number of shares in order to value this call, but this is basically the replicating portfolio, because this is the spread. You have just the right number of shares of A relative to just the number of shares of B to value this call option. Now, the D of 1 prime basically says, look, you know, we don't have a risk-free situation like we had up here. So basically the R disappears out of this model. There's no risk-free rate in this model. And the other thing to keep in mind is it's the stock of A, because we're looking at a call option on A, right, relative to B. And so this becomes SB on the bottom. So it's the relativeness of the spread here, and this is basically the spread put into a percent. Get rid of the risk-free rate, and now you basically have ND of 1 prime, and then ND of 2 prime is ND of 1 prime minus sigma square root of T. Now the other little thing is, don't forget that this sigma is the combined interaction form of the sigma that we had looked at before. It's the sigma squared equal to sigma of A squared plus sigma of B squared minus 2 sigma A sigma B correlation of A and B. And you take the square root of that. That is the sigma that's in here. So it's the sigma of the combined effect of the long in A, short in B, and the same thing goes here. And the same thing goes there. And then you really have the true ND of 1 prime, ND of 2 prime. Okay, so let's apply it. Let's apply the example to the problem that we had dealt with earlier. So let's recalculate. First we want to do D of 1, ND of 1 prime. We're going to take the log of 100 over 100, and you know what that's going to be. The log of 1 is going to be 0, plus R, but there's no R, sigma, which was, if you recall, the combined in the model we did before was 2, 3, 3, 4, 6 squared divided by 2 times T, which was 1 year, divided by 0.23346 square root of 1 year, and we end up getting we end up getting D of 1 equals, or D of 1 prime, 1167, and D of 2 prime equals 0.1167 minus 0.23346 square root of 1. That equaled minus 0.1167, and so the ND of 1 prime, which is the number of shares you needed to create this exchange traded option relative to stock A, is, let's see, it's got it written down here, 0.5465, and ND of minus 1167 is 0.4555. So therefore the value of the call, okay, on stock A, which is basically a put on B, recall, is going to be 100 times 0.5465 minus 100 times 0.554555. That is 5465 minus 4555, and that hammers out to be $9.29. So that's what the exchange option is worth. Now you might want to look at this and say, okay, so we got an exchange option, a call option on stock A relative to B. You know, could you view this as a is this an asset or nothing on stock A? Is this an asset or nothing on stock B that we've shorted? Well, it kind of is, but it kind of isn't. This is certainly stock A, this is certainly stock B, but this ND of 1 is based on the combined sigmas. It's not the volatility of stock A, it's the A relative to B. So you can think of it as a asset or not, a very special kind of asset or nothing call option on A relative to B, and then looking at B relative to A, the same thing holds. This would be an asset or nothing, where it's basically a put on an asset or nothing, but it's again using the sigma relative to stock A. Okay, now what we want to do is one more thing. We're going to go into dividends. We want to add dividends to the model and see what happens. We'll get a little more intuition. So let's go back to the basic setup so we're clear on it. So again, stock A is 100, stock B is 100, and we have sigma A is 0.26958, sigma B is 0.13479. The correlation is 0.5. The sigma between these two, recall, is going to be 0.23346. T is going to be 1 year. It's going to be we're not dealing with number of steps. I almost put that in. We're going to look at now dividends. And so when you look at dividends, we're going to have a dividend yield for stock A, and we're going to let that equal 3%. Okay, remember what dividend yield is. It's the dividend on an annual basis divided by the price of the stock. Okay, and so if the price of the stock is $100, the dividend has to be $3 per share in order to be 3%. And then the dividend yield, so that's a little d, little delta in Greek. Let's make that 5% dividend yield here. Okay, and so now let's deal with the dividend in the model. Basically, it's going to look like this. We're going to value the exchange call, and we need to adjust for the dividend yield. So we're going to have the dividend yield of A, right? And that's going to e to the minus delta A times T, right, times the stock price of A times ND of 1 prime, right? So what this does is, by the way, see this guy right here? This is nothing, this is nothing but the stock price adjusted for the dividend. We're backing out that dividend yield. And why do we do that? Because remember, when a stock pays a dividend, it draws down the stock price. And so what we're looking at is we're assuming that we have a life of an option that starts at time 0, matures at time t, and during the life it pays off a fixed dividend, a continuous dividend yield. Well, when a company continuously pays a dividend, it's drawing down its cash, and on the right-hand side of the balance sheet, its equity is falling. And if you go to the extreme, if it had a 100% dividend yield, then the company would be liquidating, and you wouldn't have any stock price, and you wouldn't have any business. And so, if you were to put sigma here of 100%, then you would have a stock price worth 0 when you're all said and done. Okay, so now let's do the effect of stock B. So we got to do that dividend adjustment on B times T times the stock price of B times ND of 2 prime. Okay, so that's what we have to do. Considering the, and then what we have to do, now we have to look at ND of 1. So let's do ND of 1 prime here with the dividend yield into it. And that's going to look like the log of the stock price, E, in this case, to minus sigma A times T times the stock of A over E minus sigma B times T times the stock price of B, plus, there's no R, it's going to be the combined sigma squared to T all over the combined sigma T. And then D of 2 prime is going to be D of 1 minus sigma square root of T. Drop the numbers in now. It's going to be the log. Now, what this comes out to be is, this is basically discounting at 3% on a continuous basis, because remember, delta A is 3%. So that's, we're going to shave this or give this stock A a haircut of 3%. And that comes down to be $97.05 here. And this is going to get a haircut of 5%. Stock B gets a 5% haircut, and that on a continuous time basis. And so that drops down about $5, right? Now, sig 0.23346 is our volatility, standard deviation, chopped in half, multiplied by 1 year, which really doesn't do anything, but we'll put it in there anyway for consistency. And then 23346 times the square root of 1, and we end up getting 0.20263, and ND of 1 prime for 0.2263 turns out to be 0.5803. Okay, you need a little, almost 0.6 shares for this option, for this exchange option. 0.6 shares on 0.58 shares on stock A. D of 2 prime is equal to this guy, 0.20263 minus 0.23346, and equals minus 0.03083, and ND of 2 prime now equals 0.4877. Okay, so now we have nearly everything we need to solve this option. So the value of the call is going to be, so we're going back to this. We're going back, where did I put it here? Where did I put it? Yeah, we're going back to this equation. So let me just use this piece of paper here. So the call is now going to be we'll use the same numbers we had, 97.05. It's $97.05. Write it a little better. Okay, which is these two combined with the 100 times the discount, basically a 3% discount, times the 0.5803 we calculated on the previous page, minus this guy, which we calculated to be 95.123, times the ND of 2 prime 0.4877. And when we get that done, let me get my calculator out. 0.5803 times 97.05, we get 5826 minus 0.4877. 46.32, and that amounts to $11.94. Oops, and I just caught myself. That's 56.32, and this comes out to be $9.92. And so, by the way, you can trick the standard Black-Scholes software that you have. So for an exchange option, so without dividends, you would put SA would be 100. Your X would be equal to your SB, because everything's relative to 100. So you would put that in as your X in the software. There's no R, so you set that R basically equal to 0. You still put in your time in years, 1 year, and without dividends there's no deltas to worry about. You need to put in your combined sigma 0.23346, and you would come out with basically the way to trick the standard Black-Scholes model into computing the value in exchange option. Now it's slightly more difficult, a little more complex when you have dividends. So again, the trick would be, the inputs would be stock A is 100. You would put in X, which is really SB, equal to 100. T would still equal 1 year. Yeah, we'll have delta A which was 3%. That will be our dividend yield for this option. Okay, delta B will end up being, which is 5%, will end up being R. So we want to put 5% in for R in the model, and we want our dividend yield for the overall exchange option to be the 3%, which is the delta on A. And that makes sense because, well, you know how you look at it. If you go back to this page that we had here, we have ND of 1 prime, and one way that you could adjust the model is, look, you can just back out the present value of the dividend, that $3, from the stock price of A and B, and go on your merry way. That's one way of doing it, but there's another way to do it that is very insightful. Is you can cross out this part right here, this component right here, cross this part out, and what you can do is insert for R. Remember, R used to be here. Well, R, since it is now delta B1, so you're going to put delta B here, because this is underneath a fraction with a negative sign. Delta B now is acting like the risk-free rate. Okay, and then you're going to minus the delta A, because the delta A is still dragging down the value of the call. It's on top, and then this is a call option for the exchange option to receive A in place of B. You have that on a rate on a rate basis, and so you will end up with the same D of 1 prime, which was 0.20263 as we calculated right here. You're going to get the same effect, just in a rate form. And so by understanding that so mathematically it's the same, understanding that will allow you to help visualize why the little tricks to the standard Black-Scholes model works. And so that's it for exchange traded options. A lot of work on it, a lot of detail, but very insightful.